the old climate change is at play, do you think? Or is it just the seasonal stuff that we're getting? Speaking of which, there's a lead into market data.
Yes. Well, okay, man. Well, do you know, there's some really interesting things to talk about today, because last week, as you know, I've been sort of like looking at seeing if there were any opportunities to go long on the stock market, but absolutely terrible, really. Now, I'm going to sort of show you a couple of things. So we're going to talk about the FTSE, and we'll talk about the Nasdaq as well, because it's quite useful, really, to sort of give us a gauge of sentiment, of confidence out there, because it is the risk on index, really, of the planet. So last week on the FTSE, now. When we look at this data down here, this is our volume. Now, this volume, if we compare it to the prior 3 months, there was a volume spike on this particular bar here on the FTSE 100, which showed that expectation was for the FTSE to start to rally. But the very next day, this happened. And it's on equal high volume. So straight away, we're looking next week at potential shorts in the FTSE, and we'll bring the Nasdaq in a moment. But let's talk about why, really, if we sort of think about the global situation and global equities, why things are moving in the way they're moving. And it's really about back to the kind of old adage of inflation and what's happening with the central banks. So if we have a look at last week's data and what was starting to move things with the FTSE. Now, last week we had this situation with the pound, where Kwasi Kwarteng, the Chancellor of the Exchequer, released a mini budget suggesting that there would be a lower rate of tax for the highest earners. The market hated it. And it prompted the Bank of England to come out and say that they would be buying treasuries on the long end of the curve, just to try and calm the markets down a little bit. It did a lot of things. We saw the pound getting very, very volatile and going this way and that way. Now we got a new chancellor. So this week this weekend we had a new chancellor announced, and it's Jeremy Hunt, and he's straight away come out and saying we're not lowering the highest rate of tax, and there's a big chance that the taxes will probably be risen rather than quashed. Now, that should initially raise the price of the pound. That should be quite bullish for the pound. So we'll see what happens off the back of that. But the reason it's going to be bullish for the pound is that it probably then puts the Bank of England back in the hot seat to say, you are free now to raise interest rates, forget the long end of the curve stuff, and you can deal with the market that you should be able to deal with. Initially, it's sent global waves around to suggest that if a central bank is going to be buying on the long end of the curve, they are going to get more dovish, and that might well filter into everybody else, which is why we saw some bullish price action on the FTSE, the Nasdaq, and everything else. But now with those guys back in play, that should be quite negative. And if we look at what really happened from the United States, we had PPI data coming in 0.4%. So it was from negative 0.2% to 4%. Now, PPI data is inflation. So inflation, hot. Central bank, raise interest rates, bad for the stock market. FOMC minutes, reiterating, we're going to keep going. Forget sort of like thinking you're going to get comfortable. We're going to go hard. Bad for the stock market. CPI data, month on month, 0.4% from 0.1. Hot, inflation up, suggesting central banks raise interest rates, bad for the stock market. Now, that was on Thursday. And then on Friday, we had retail sales coming out at 0 and core retail sales at 0.1. So core retail sales is what they tend to look at. And we had consumer confidence coming out at 59.8 from 58.6. Decent consumer puts the central bank on high interest rates, bad for the stock market. So what we've basically seen this week is a catalogue of things coming out and saying central banks are not going to help you guys out. Forget buying stocks, because stocks are not going to be worth the same as holding your money either in cash or maybe even in a bond. You know, we see the bond yields kind of going crazy right now. So the stock market looks in terrible shape, mate. That's the sort of like the long and the short of it. Now, if we bring in the Nasdaq and get a clearer picture about sentiment, you know, overall sentiment, then let me see if I can bring in my whole screen. We can. This is what we got going on. Same thing with the Nasdaq. Saw a decent bar, not on quite as good volume, to be fair, but a decent bar on Thursday. That consumer sentiment came out and it just, you know, it just got obliterated again. Very negative looking bar. The Nasdaq currently sits at significant levels along here, which makes it very difficult to short, very, very difficult to short, you know, because it could fly in the opposite direction at any point. And you see that with a price action on a day-by-day basis. Look at this. This is CPI data release. CPI data comes out, it comes down. Then all of a sudden, for whatever reason, the market decides that maybe the central banks won't be raising interest rates. I think that might have been to do with what was going on in the UK. Then they buy things back up again. But we are back down. And that is suggesting that, and look, a little gap. I mean, that is very unusual during an intraday move to see a gap in the market there. And that intraday gap suggests that there is aggressive selling going on. So very little suggests that we should be buying stocks right now. Very, very little. And you know, and you include the fundamental aspect as well. If we look at the COT data shows us, let's change this back to a daily chart. The COT data shows us that just going into the week that it was starting to weaken. Now, it's not at this extreme here, but what we are seeing is a string of more confident COT data to starting to come in. And then all of a sudden, is this a little bit of a key to suggest that any sort of now this COT data is week on week, and it started on the in the middle of September, so around about this point here. So as this started to fall, the speculators were basically saying this will hold. This is going to hold, no problem at all. But what happened was it had a little bounce, and then it started to come down again, really into last week. Are they now saying, okay, this is possibly panic stations, this isn't going to hold, we might need to flip positions? Because if you look at what happened here, this was back in, this was in March, and then the market started to drift down sort of like on the 23rd of March, and that will coincide with March is here. Here, they started to buy it up, but by the 23rd, which is there, they started to get very, very concerned, you know. So that they were quite happy with the rally, buy it up into the rally, but then tank it down, you know. And even when they were buying in this particular period, which is really through May, which is starting around about here, the market came down a little bit, then it came up a shade, but then they started to panic again and start to sell it off. Is this what's happening here? You know, the market managed to hold up a little bit. They managed to clear out some positions. Now they're flipping positions. I mean, that's not a huge decrease. It's not like this one, where it's just out and out panic. But it does suggest that there could be a little pattern forming here where they buy it up for a period, maybe get some people involved, and then they start to sell it off. Now, as I say, mate, difficult at this particular level to short this market. But nothing is suggesting that we should be buying it. Nothing, which tells us that if we can get a decent price and we can maybe use the correct money management, making sure that we're not over leveraged, that the only place really that we should be looking is for a short. There's CPI data due from Canada and the United Kingdom this week. From the United Kingdom, it's stated to go to 10%. Again, not particularly good for the stock market. So if we're looking to play the stock market this week, and I know this is more about the FTSE, but you know we do need to check the other markets, Nasdaq included. The FTSE does suggest downside, We always have to consider oil. And the reason we always have to consider oil is that the two biggest companies, or two of the biggest companies in the FTSE 100, are BP and Shell, and they are oil companies. And if we were to look at all the data, I know we don't have time now, but if we were to look at all the data, what we would see is a weakening of an economic global picture while interest rates are going up. That suggests recession. That suggests lower prices in oil, even with OPEC Plus and all their jiggery pokery. It still suggests lower prices in oil, which again would filter back through to the FTSE 100 being weaker. So this week, mate, looking at market index coming down.
Yeah, I was saying at the head of the show that there's a fundamental versus technical flavour about the traders that are in the room tonight. Lenka, of course, being a pure technical trader, yourself relying very heavily on fundamentals before you look at technicals, and myself a little snippet of fundamentals, but mainly technical. And it's now, if you look at that NASDAQ chart as you were before, as you say, it all looks very, 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 very bearish. But to go short right now, because of the technical level, is just so dangerous.
Yeah. Yeah, it is. And one trade you can always do is a spread trade where you go NASDAQ short, FTSE long. But even that is difficult, because if the NASDAQ, if something happens, we were just talking in the Elite Trader Support about how a speech can change everything. And even though the data suggests one thing, a central banker can come out, and we saw it with the pound, right? So we saw it with the UK. When Bailey came out and said, look, we're going to have to prop this market up a little bit, we started to see some risk sentiment going in the opposite direction. Now, of course, something could happen this week which completely changes the dynamic, and it completely changes the terrain. Then maybe there is some relief in the situation in Ukraine. Maybe OPEC Plus come out and say something else. Maybe one of the central banks come out and say, actually, maybe we won't be able to go any further than 4.25% in interest rate, and that would probably strengthen the NASDAQ. So we don't know if somebody's going to say something, which makes it difficult, because if somebody sniffs at any kind of dovish pivot, the NASDAQ's going to fly, and you can get caught into a short and be, run over. So that's why shorting is very difficult here. But going long, without those factors, without a central banker coming out and saying something dovish, is not going to happen. We can't say that anything with 100% confidence, but it's very unlikely to happen that this thing can go long. So as a trader, where does that leave you? Well, it leaves you with a situation where you've got to be very cautious, and you've got to make sure that you've got your money management tight. That doesn't mean tight stops necessarily. It just means that you've got to be right on top of the way that you're going to approach the market, the way that you're going to handle it if it goes in the opposite direction, and your psychological, approach at this particular point. So it doesn't mean don't trade. I think not trading is not the best option. I think sort of trying to find stuff is the right thing to do, but be very careful if your expectation is that you are going to make, that the market is going to either fly or fly without any kind of response, because at any point it could flip around and do something dangerous. So just make sure your money management's tight and your psychology is correct as you go into this week, because I think it could be an interesting one. And I tell you what, mate, the data this week is thick. We are talking about heavy stuff. We're talking about CPI data, which is driving this stuff right now. It's driving this market hard. So we're talking about CPI data from a number of countries. And it does mean that this week is, potentially, as this market has been for a number of months, it's going to be a challenge. So make sure that you're ready, and make sure you're ready to lose. That's a big thing. Make sure you're ready to lose and you can accept it, and it's not a big deal, because the market calms down and it makes things a lot easier. So, and on the flip of that, make sure you're ready to win, because, that can also have a psychological impact. So psychology is going to be key, I think, this week.
Mate, sounds like a good week ahead. You're talking all this movement, then we could be part of all of that. And as you say, if you get it wrong, make sure that you've got that risk management under control, because that's what the key is here in a market such as this. Get your risk under control before you enter the market. rather than think about it once you're in it. And that'll be the key, I think.
Yeah.
All right, buddy. Have a great week. We'll catch you tomorrow in Trading Buddies at, I won't say what time because you'll be confused because daylight saving, won't you? Well, I am. 5 to 3, Singapore and Hong Kong time. That's all I can tell you. And 5 minutes before London.
We haven't got daylight saving yet here, mate.
No, I know. It's a couple of weeks away, isn't it?
Oh, cool. Okay.
I told you you'd be confused.